Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields still tethered to 3%. We make a little move away, we get back. We got above it a few weeks ago, we came back, but we really have been unable to break away from the magnet that is 3% for any sustained period. I think that's going to be the trade here. Which way are we going to go when we do decide to break away? Is it going to be a rally of yields pushing us north of 305, which probably should set off a short selling, some kind of a short selling system, or will it be a move back below 290, which could get some of those shorts to get squeezed out? And I think right now it's very uncertain as from a technical standpoint. We need to see some kind of a move. Not only is it in treasuries, we're also seeing the same kind of formation in gold, but right now it's just very uncertain, given all the uncertainty around the globe, given all the markets that have been moving around, very volatilely in the last month or so. It's very odd to see treasuries just kind of spinning their tires, hovering at this level. Obviously, this is a level we've been pointing at for some time, and once we got here, we really haven't seen much of a trade away from it, albeit we saw the move up to 303 and then we saw the move back to 290. But other than that, it's been very, very much a tired trade in treasuries. And if you look at volatility continues to trend lower, and it's very odd given what we're seeing in Syria, what we're seeing with the Iran nuke deal, the movement we're seeing in equities, the rally in the dollar, the trade talks that continue with China, the NAFTA talks that are still up in the air. Well, where is the move in volatility? Not for fixed income, it just isn't there, and it hasn't been there for a long time. And when we look at the low volatility levels in the equity markets, I think that's because there's more attractive areas to buy insurance than there is. You can buy two-year note yield at 2.5% yield, or you can buy any other type of instruments that would be more attractive, I think, than buying VIX calls or buying S&P puts, which would typically drive up volatility in the equity markets. But in treasuries, we're just not seeing that angst. We're not seeing that fear, or at least the beginning parts of fear that would cause volatility to go higher with all this uncertainty around the globe. It's very troubling, I think, to see volatility at this low. And let's look at that two-year note yield. It's been really the driver of the curve here. So if we look at two-year note yields at decade highs, I'll repeat that, decade high yields north of about 255. We got it continues to see that 210 curve trade remain very flat. Yeah, it's not on the the uber flats that we've seen, but it's hovering near those decade low flats, and it will continue to do so, especially if you take into account that it's already priced in a June rate hike, and will likely, if the Fed comes out with a hawkish tone at the June FOMC, you could see that two-year note yield take off, and I very much doubt that we'll see the same in 10-year. So right now, that curve looks to continue to flatten. Despite the fact that we are seeing an economy that's getting its legs back under it, we are seeing a more hawkish Fed, and we are seeing inflation and growth both rise, although maybe not at the speed or the levels that the market anticipates it should be at this level of a recovery. So right now, Treasury notes, 10-year Treasury still hovering at 3%, looking for that breakout move. Unlikely to get it this week unless something comes awry from the talks with China, but those are looking to be smoothed over. We should get some kind of resolution by week's end. This is Todd Colvin coming to you from the floor of the CME Group.